Welcome students to our last module of the course. In this module we leave the WACC, discount rates and capital structure policy alone and start talking about dividends because most of the times that's what makes investors buy shares in a company. The cash flows, the dividends, the return to investors is quite attractive and that's why people invest in shares. In this module we discuss dividends and dividend policy as they are an important part in the life of the company. This is the third area of corporate finance, the dividend decision. Depending whether a firm will pay dividends or not, it will have an influence on how the market and investors value the share of such company. Therefore, in this module we look at cash dividend types, how they are paid, and measures of dividend policy. We investigate the issues surrounding the dividend policy decisions in the sense that we ask the question, is it better to have a higher dividend or a lower dividend? Is it better to pay cash dividends or repurchase shares? Should the firm pay a dividend to its shareholders or instead with the money invest in projects and ultimately increase the shareholders' value? Essentially, the firm has three decisions with respect to its earnings in a given year. Number one, reinvest the earning as internal equity in the business. Number two, pay the earnings out to shareholders in the form of dividends. And number three, repurchase outstanding shares. Does it matter which of these policies the firm adopts? In theory, we will see that it is irrelevant. However, in reality, most firms undertake a combination of all three. This decision is important because it determines what funds flow to investors and what funds are retained for the purpose of investment in the firm. So there is an interrelationship between the firm's financing and investment decisions. It is a complex decision as it depends on real-world factors like taxes, transaction costs, and shareholders' preferences. Back in 2010, a couple of years after the GFC hit, companies started to bounce back, announcing big profits following improved consumer and investor confidence. These higher earnings led to firms paying high dividends as well, some of them for the very first time too. Starbucks was such a company which after 2 years of hardship recovered well enough to pay their very first dividend in 2010. The term dividends refer to cash paid out of earnings. If a dividend is made from other sources than retained earnings, we use the term distribution rather than dividends. As cash dividends, we have ordinary dividends. Australian listed companies pay dividends twice a year, usually as an interim dividend and a final dividend. However, companies are not limited to pay twice a year and may pay more or less frequently. Then we have special dividends, typically used when the company wants to make a one-off payment, often found in cyclical industries or when substantial assets are disposed of, as in a liquidating dividend. It enables firm to pay a low stable dividend and increase when times are good. Shareholders like the stability of ordinary dividend and are pleased when the firm pays a one-off special dividend. The firm can reward the shareholders by paying special dividends without altering the long-term dividend policy. And then there are share repurchases or buybacks. Happens when company buys its own shares from investors using corporate cash, which is the same as a cash dividend. The non-cash dividends are in the form of dividend reinvestment plans. This allows shareholders to receive new shares instead of cash. For shareholders, the advantage is that these shares are often issued at a discount and no brokerage or stamp duty is paid. Thus, the firm retains cash and at the same time accumulates equity capital cheaper than having to pay for a new share issues in the market. Then we have share dividends. These are paid when shareholders elect to receive all or a portion of their dividend in shares instead of cash, also known as a bonus share issue. And it's expressed as a percentage, and it's applied to the number of shares already held by the investor. And last, we have share splits, which are similar to share dividends, where company issues shares to existing shareholders based on their current level of ownership, and it is expressed as a ratio, for example, a 3-for-1 split. The decision to pay a dividend rests with the board of directors. They have a meeting, and if they decide, okay, let's pay the dividend, they make it official and announce it. Once a dividend has been announced, it becomes a liability to the firm, and it must be paid. After the declaration date, a next dividend date is set by the brokerage firms and exchanges for the purpose of establishing the individuals entitled to the dividend. Shares are bought and sold every day. This ex-dividend date acts like a cut-off date. If you buy a share that has a dividend declared before the ex-dividend date, you receive the dividend. If you buy the share on or after the ex-dividend date, you don't receive the dividend. It goes to the previous owner. Usually this date is 4 business days, not calendar days, before the date of record. In the United States, the ex-dividend date is 2 business days before the record date. In other countries, it might differ as well. In general, on this date, the price of the share drops by the amount of dividend to reflect the fact that the individuals purchasing the share don't have the dividend attached. The date of record is when the company prepares the list of shareholders in the books for the purpose of writing the checks, and the date of payment is the date when checks are mailed. This table displays the Big Four banks' dividend amounts for 3 consecutive periods during the 2012 and 2013 financial years, together with the relevant dates surrounding the dividend, what type it is, and whether it's franked or not. Commonwealth Bank has the highest dividend, followed by the National Australia Bank, Westpac, and ANZ. All of them pay dividends twice a year, which are fully franked, meaning that full tax has been paid by the company already. When it comes to dividends and dividend policy, investors and analysts are interested in 2 measures. One of them is dividend payout, which measures the proportion of earnings that the company pays in dividend, and the dividend yield, which measures the return received from dividends alone, which together with the capital gains yield may make up the return on an investment. In Australia, companies have a focus on cash dividends. Most industrial firms in Australia pay either fully or partially franked dividends. Currently, the yield on the Australian market is around 4.45%. Typically, the resources sector has a lower dividend yield because of the focus on reinvestment and capital growth. Some companies declare a dividend policy. However, until 1989, Australian companies were prohibited from undertaking share buybacks. This was changed in 1995. However, the law governing buybacks is still very rigid compared to the US. A recent example of an off-market buyback is Woolworths Limited. As of January 2015, the Australian dividend yield was 4.45% in comparison with the rest of the world, which sits at just over 2%. These are some of the types of dividend policies that companies adopt. The constant payout policy pays the same percentage of earnings each year. This policy depends on the earnings of the firm, because if earnings are low in one year, the dividends will be low as well, and vice versa. and this will result in a volatile dividend payment. The constant nominal payment policy ensures a fixed dollar dividend each period, thus avoiding dividend volatility. With this policy, the firm increases the amount of dividend only if the sure expected earnings can support these high payments, and never cut the dividends unless a disaster happens. The reason is that dividends convey signals to the market. This will be discussed later in the module. In some cases, companies offer a low regular dividend payment, which ensures continuity of income to investors without giving them false hopes, and also provides stability in the market with respect of signals. Then rather pay a special or extra dividend when earnings are higher than normal. As we mentioned, the company can pay dividends in the forms of shares instead of cash dividend. This payment causes an increase in the number of shares outstanding, diluting or reducing the value of each share. They are also known as bonus issues. Usually a share dividend is expressed as a percentage and is applied to the individual share ownership. For example, if an investor owns 100 shares already and a share dividend of 10% is declared, the investor will receive 10 shares, totaling 110. So to find out the new number of shares, we take the old shares and multiply by 1.10. To find out the new price per share, we take the old price and divide by 1.10. Shareholders receiving the share dividends maintain a constant proportional share in the company's equity, and the net effect on their wealth is neutral, as shown in the example. Before the share dividend, the investor had $3,000 in wealth based on 100 shares at $30 each. After the share dividend, investor still has $3,000 based on 110 shares, but at a lower price at $27.27 each. Supporters of share dividends argue that sometimes a share reaches a price that is too high to be traded by common investors. Issuing share dividends reduces the value of the share to an optimal trading range. Not only is the share more affordable, it also avoids odd lot transactions and helps the share become more widely held. Stock splits is the same as a share dividend expressed as a ratio. As with the stock dividend, the share price is reduced proportionally, and the argument for doing it is that it brings the share price within a more affordable trading range. To use our earlier example of an investor owning 100 shares at $30 each and a total value of $3,000, a 2-for-1 split means that for 100 shares that the investor owns, he will receive another 100 shares. So for one share that he has, he gets one more, ending up with 2, which is similar to 100% share dividend. So we have a new number of shares higher than the previous number, and a new price which is lower than the original price. What about if the same investor goes through a 3-for-2 stock split? For every 2 shares owned, the investor will receive another one. So 3 minus 2, 1 additional share. So what is the number of new shares and what is the new price? We apply the formulas presented, and again the new shares, the new number of shares are 150 shares, and the new price is $20. Remember, with the share split, the number of shares outstanding increases and the prices gets diluted or decreases. An alternative method used by companies to pay out a firm's earnings to shareholders is to repurchase their own shares. Share buybacks indicate that the company perceives their stock to be undervalued. By repurchasing their shares, the value of the remaining shares increase as earnings are split among fewer shares outstanding. Share repurchase is also known as share buybacks and is usually done when the company has surplus cash and are subject to Corporations Act and the ASX rules. Generally, companies are able to purchase about 10% of their ordinary shares in a 12-month period. There are 5 types of buybacks. Equal access purchase, where all shareholders are invited to sell to the company directly. On-market purchases, where is a purchase by a company of its own shares on the open market. Employee share purchase, we purchase shares from employees that were issued under Employee Incentive Scheme previously. And then we have selective purchase, where the company repurchases shares from specific shareholders. And odd lot purchases, where the company repurchases small parcels of shares. Share buybacks are similar to cash dividend, and in a perfect world, investors' wealth is unchanged. However, in a world with taxes, share repurchases implies that they enhance shareholders' value, perhaps because the difference in the capital gains and will be deferred, and the tax on cash, which has to be paid when received. The practical motives for share repurchases include obtaining shares to be used in acquisitions and having shares available for employee share options plans. Let's look at an example to see that from an investor's point of view, like with the share splits, the wealth is unchanged irrespective of what the form the dividend takes. We have this firm that has $100,000 to pay to the shareholders. This is the current balance sheet. The assets on the left-hand side must equal the liabilities and equities on the right-hand side. The number of shares outstanding is 100,000 shares at $10 each, which makes the total value of the firm to be $1 million. What should the company do? Pay the $100,000 in the form of cash dividend or repurchase $100,000 worth of shares? If an investor owns 100 shares in this company, his total wealth is $1,000. If the company decides to pay the dividend in cash, the balance of cash is reduced to $50,000 on the left-hand side. The number of shares outstanding is the same, 100,000, but the value of the firm becomes 900,000 because the stock value decreases by the amount of dividends, as we said previously. In our case, is $1 per share. Thus, from $10 a share, it becomes $9 a share. If the investors who owns 100 shares receive the $1 cash dividends, his total wealth is $100 in form of cash from the dividend and $900 share value, which comes from 100 shares multiplied by the value per share, which is $9. Overall, his total wealth is $1,000, same as before the dividend payment. Now, if the firm decides instead to repurchase the shares, again, the cash balance is reduced from the asset side of the balance sheet. The difference here is that the number of shares outstanding reduces as well to 90,000 because the company repurchases 100,000 worth of shares or 10,000 shares. The price per share remains $10 as original value. The end result is that the value of the firm stays the same as with the cash dividend as $900,000. If our investor participates in the stock repurchase according to the ratio of repurchase amount divided by the equity, in other words, the 10% repurchase amount ratio, sells 10% of his shares in other words, sells 10 shares at $10 each and receives $100 cash from the repurchase, and keeps the remaining shares, which have a value of $10 each, and becomes $900 in share value, and in the end the total wealth is $1,000 as before, as with the dividend payment in cash. So whether a company chooses to pay dividends or to repurchase shares, it doesn't matter, the investor's wealth is unchanged. Again, in a perfect world, the dividend policy is irrelevant. We've seen that paying dividends matter because it affects the value of the share. Remember how we value a share: present value of all future dividends. If there are no dividends, the value of the share will only be based on capital gains. Now, the next discussion is about the dividend policy. And we will see that in a perfect world, it is irrelevant because it doesn't change the value of the firm. Dividend policy is just the time pattern of dividend payments. The decision to pay larger dividends versus paying smaller dividends and retaining funds to reinvest in the firm, or pay cash dividends versus repurchasing shares. The reason it doesn't matter is that if the firm pays low dividends today, it reinvests more capital, grows faster, and pays larger dividends in later years. Or on the other hand, if the firm has higher payout ratio now, it will reinvest less capital back into the firm, therefore lower earnings later and lower dividends. This irrelevance theory proposed by Modigliani and Miller has a few strict assumptions, such as no company taxes, no transaction costs or market imperfections, no personal taxes, and a fixed capital budgeting program. Miller and Modigliani, M&M, showed that dividend policy cannot impact company value in a world without market frictions. They showed that dividend policy was irrelevant in the same way they proved that capital structure was irrelevant, in the absence of no costs and no taxes. The theory suggests that the value of a firm is determined by the future cash flows of the firm's assets, the earnings, and the shareholders don't care how these earnings are split between dividends and retained earnings. Value derives solely from the inherent profitability of the company's assets and the competence of its management teams. And if investors are not happy with the company's dividend policy, they can create their own homemade dividends to mimic the desired policy by selling shares or reinvest excess funds. If, for example, the firm increases dividends and everything else stays the same level of reinvestment, then yes, dividend policy matter. For example, we have a firm called Payout, with assets worth $20 million and expected cash flows of $2 million next year. There is an opportunity to invest in a project all these $2 million of cash flows. Now it has 1 million shares outstanding at a value of $20 per share. The shareholders' required rate of return is 10%. Payout decides to pay out all its cash flows as dividends, which means there is nothing left in the retained earnings to undergo the investment or the project. Therefore, they need to raise $2 million worth of funds by issuing 100,000 shares at $20 each. We observe that after paying the dividend and raising funds, the value of the firm is $22 million. Shareholders earn the required return only from the dividend received as the dividend yield. The share hasn't gained in value, so there is no capital gain. So that 10% is just the dividend yield. $2 divided by $20, the share price. Now we have another firm which we call it retain, with the same assets, cash flows, investment opportunity, and shares outstanding and prices. But retained company chooses to keep the $2 million in cash flows and invest those money in the project and pays no dividend. We observe that by paying no dividend and retaining all funds in the firm, its value is $22 million. And the shareholders earn their 10% again, required return, which now is made up of capital gain only, because there is no dividend and the share price has increased from $20 to $22. So therefore, the 10% is made of the change in the dollar value of share divided by the original price per share. As proposed by Modigliani and Miller, in a perfect world, dividend policy does not matter, because as our example has shown, regardless of the dividend policy, the value of both companies is the same. The value of the firm only depends on the investment it undertook. So far, we've discussed the dividend policy when the markets are in equilibrium. No friction, no costs. In effect, the markets are perfect. However, in the real world, markets are imperfect, and because of this, dividend policy might be relevant. Because of the agency relationship between managers and shareholders, the agency cost or the contracting model proposes that firms pay dividends in order to reduce agency problems. Instead of using cash flows for perquisites, making bad investment decisions, or hoard excess cash, managers pay out this cash in the form of dividends, thus reducing the need for shareholders to monitor the managers. Investors understand the temptations that managers face, and when the firm decides to pay dividends, they take it as a good news which will lead to a share price increase. Accordingly, the model predicts that firms with high excess cash flows will pay high dividends. The data supports this, as based on ownership structure, we see that big firms have higher payouts as opposed to private and small public companies who rarely pay dividends. The agency problem will be higher for big public companies, and to overcome that problem, management pays dividends. Similarly, mature companies have higher dividends compared with high growth companies who retain all their funds for expansion and growth. The other reason why dividends are important is that they provide signals to investors about the firm. Due to the information asymmetry, managers know more about the company than the investors who put money in the company. And because dividends are so important to shareholders, any information released from management related to dividends and dividend policy, it's a signal to shareholders about the health of the firm. Accordingly, whether there is an increase or decrease in dividend, it will have a corresponding effect on the share price. This is called the information content effect, or the signaling effect, because the market reacts to changes in dividend payout. An anticipated rise in dividends, all things equal, is often treated as good news by investors because it indicates management's confidence that the company's prospects are improved enough to pay these higher dividends into the future. An increase in dividend is the management's signal to the market that the firm is doing well. The share price often reacts favorably because expectations are raised upwards, meaning that the present value of the share increases. Similarly, since in the past investors have often reacted badly to unanticipated cuts in dividends, shareholders know that the board would not lower dividends unless the management thought the company has a reduced capacity to pay dividends in the future. This negative news thus often leads to a fall in the share price. There are some real-world factors that make the dividend policy relevant. So in real life, we do have taxes and other costs. And because of these, sometimes companies and shareholders prefer lower or higher dividends. A low payout might be desirable for individuals when they are in a higher tax bracket. They don't want to increase their taxable income given that they have to pay more tax on it. Rather, they would desire an increase in capital gains. Having said that, we know that in Australia we have the dividend imputation system, which prevents the double taxation of dividends. For companies, if they pay low dividends, they don't have to raise large amounts of capital to use in the new projects. Therefore, less capital raised, less share and bond issue costs. At the same time, companies might have restrictive debt covenants, which specify or limit the amount of dividends they can pay out of income. For example, if a company has issued bonds in the past, one of the conditions of lenders might be to have only a certain amount of earnings paid to shareholders so that enough remains to cover interest payments. Now, we said that in Australia we have this dividend imputation system that prevents the double taxation of dividends. This system has been implemented in Australia in September 1985 and was welcomed as it gave some relief to investors by allowing them a tax credit on dividends received as a result of the tax that was already paid by the company. These imputation credits allows investors to reduce their overall tax liability on income, whether this income is from dividends or from other sources. Therefore, the most desired dividends are the franked dividends because the company has paid tax on them. In Australia, the company tax is 30%. So when a company declares dividend on which fully tax has been paid, we call them fully franked dividends. Given the 30% tax rate, this means that for every $7 in dividends, there is a tax credit of $3. Dividends can also be partially franked, meaning only a portion of tax has been paid on them, or unfranked, where no tax has been paid. Historically, the main tax systems are the classical or double taxation tax system, which is applied in the United States, and the imputation tax system, which is applied in the UK, New Zealand, and Australia. In the classical system, net income is taxed first at the company level and then is taxed again at the shareholder level. The effect is that dividends are taxed twice, and the effective tax rate is high as a result. Therefore, there is a disincentive for all shareholders to receive dividends, and they may instead favor share dividends and buybacks. These are some examples on how the imputation system works on various levels of taxable income and their associated marginal tax rate. As we said, for every $7 in dividend received, the shareholder gets $3 in credit. So in our case, if the dividend received is 70, let's look at column 1, tax credit is $30. The way the imputation system works is that the grossed up amount is included in the assessable income. The grossed up amount is calculated as dividend divided 1 minus 30%. The tax paid on this grossed up amount is calculated using the marginal tax rate. So because we have a tax credit of $30, we can reduce the tax paid. And for the low income earner in the column 1, they can actually get a refund of $11. There is also a case for a high dividend payment. A higher payout might be favorable in three instances. The first is when there is a desire for current income. This will apply to individuals that are in need of immediate funds, such as retirees or other people on fixed income. In a world of transaction cost, implementing a homemade dividend policy by buying and selling shares can be costly in terms of brokerage fees. Similarly, various businesses entities such as trusts and pension funds may be banned from spending capital, therefore cannot create a homemade dividend by selling from existing shares, and some of these funds are prohibited from investing in companies that pay low dividends in the first place. In this instance, shareholders in low tax brackets, such as superannuation funds, prefer dividends income and use the tax credit to offset tax liabilities elsewhere. The second instance has to do with uncertainty resolution. According to Gordon, 1961, investors prefer a high dividend policy because it resolves uncertainty. In this theory, it is argued that investors value a stock by estimating and discounting future dividends, as we know. Therefore, forecasts of dividends to be received in the distant future have greater uncertainty than forecasts in the near future. Better to have high dividend now. The third instance has to do with taxes. And yes, we said previously that taxes favor a low payout. However, when companies become shareholders in other companies, the dividends received are taxed at a lower rate. Thus, the shareholders' companies received an enormous tax deduction. The other case is when investors are exempt from paying taxes. Depending on the country, some pension funds or trust funds are completely exempt from paying taxes. Because their income is tax exempt and don't have to worry about paying taxes, of course they want higher dividends. In Australia, funds do pay tax, but at a lower rate. For example, the superannuation funds pay 15% tax only. Observation on the market suggests that companies have long-run target dividend payout ratios. And companies change their dividends based on changes in the earnings that are sustainable over a long period of time. Managers don't want to increase dividends if they might have to decrease them later. This appears to be a bad signal to investors who value consistent dividend policies. All this relates to the dividend signaling model, where the market does take in consideration increased dividends as positive news and dividend cuts as bad news. The evidence has shown that taxes influence payout policies to some extent only and do not prevent companies from paying dividends or repurchasing shares. These are some results from a survey as to the CFO's decisions regarding dividends and share repurchases, which shows that managers strongly believe in the signaling model, where distributions decisions convey information about the company. And they consider cutting dividends as having negative consequences to the company, in contrast with share repurchases, which are considered more discretionary and don't have such an impact on the market if they are reduced. This is further evidence on share repurchases and the motives behind engaging in such practices. The majority of managers believe the share is undervalued, and that is the reason why they engage in share repurchasing. Similarly, a large proportion believe that if there are no investments out there to increase the value of the firm, then it is better to pay shareholders in the form of repurchases. Others say they do it because they want to increase the earnings per share and to offset stock option dilution. This is the last project activity based on Module 10. For your chosen company, calculate, graph, and discuss the trend in dividend and dividend yield. You might have done this in the very first project activities at the beginning of the course. Find out what is the payout ratio and what type of dividend policy the firm has, and how does it compare with the competitors. Also, identify what type of dividends the firm pays. Are they fully franked, regular, special, twice a year, or more than twice a year? Is there any share repurchase, share split, bonus issue activity in the firm? Given the firm's characteristics today, assess whether the firm should pay more, less, or no dividends at all, or whether the firm should engage in share repurchase. This concludes Module 10.